When we look at the AI trajectory and the CapEx that is anticipated from the largest hyperscalers in the market now, there does seem to be a very long runway of additional spending and investment in data center demand. So I do think over the long term, these are still relatively attractive investment opportunities, and the constraint on supply is only contributing to pricing power going forward.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. In today's episode, we're taking our monthly look at a REIT sector. For July, that's data centers, and with me to share his insights is Brendan Lynch, co-head of US Equity REIT Research at Barclays. Brendan, welcome to the podcast.
Great. Thank you, Sarah.
So, Brendan, last year, data center REITs were the worst performing part of the REIT market, and this year they're up more than 30% year to date. We're also seeing jumps in real estate fund allocations and a $1 billion plus IPO from Blackstone. What does that tell you about where the market is right now?
Good question, Sarah. So when we look back over the last 18 months, there was some caution at the beginning of that period over the role that the public data centers were going to play in the AI build-out. There seemed to be a little bit of a slow demand environment for enterprise AI and the smaller type of deployments that were in theory going to accompany the AI build-out, specifically on AI inferencing. But what we've seen over the last 6 to 12 months is that there's been an acceleration in that enterprise demand, and the public companies are benefiting from that in both their bookings, momentum, and their revenue growth. In terms of the Blackstone IPO, I think that highlights how investors have relatively few ways to play the data center build out directly through data center exposure. And they're looking for additional ways to express the view on the data center build out. It also highlights that there are investors who are looking for a specific type of exposure, notably stabilized assets, as opposed to the public companies that were available prior to the IPO that had a mix of development and stabilized assets. So there's a niche for all types of investors. And I think the IPO of Blackstone, there's just more ways to play the space.
And as you look at these record leasing pipelines, what is that telling you about whether that demand is going to translate into more durable long-term cash flow growth?
Certainly, as we see these leasing pipelines just grow and the bookings momentum accelerate, we do anticipate that we will see that translate not only to revenue growth, but some element of margin expansion and additionally cash flow growth as these companies get even greater scale than they have already.
And Brendan, there's also been a lot of focus on capital spending and development costs in the data center space. How should investors think about development yields and returns today versus just a few years ago?
When we look at development yields a few years ago, going back to say 2021 and 2022, yields were really just in the kind of 6 to 7% range. And that was partly reflecting the interest rate environment at the time. As rates have increased, we've also seen development yields increase as well. And depending on the type of data center, we can see yields anywhere from kind of the low double digits now up into the mid-teens. And there's lots of nuances around that in terms of whether it's turnkey or powered shell, or it's catering to more enterprise demand. So there's a range of yields, but by and large, those yields have improved over the past couple of years. I think it's also important to know that when we hear about how strong the demand environment is, and it has clearly been strong for quite a while now, but the yields have not increased to a really high level, in part because many of the clients and tenants of data centers, they can build these facilities themselves. So they know exactly how much they cost. And the option to insource development kind of keeps yields from getting too stretched relative to where they were a few years ago.
And power has become such a huge part of the story for data centers. When you think about the next wave of development, which markets seem best positioned and which ones would you say may run into more challenges?
Sure. So throughout the U.S., there are pockets of power available. We often hear about all the constraints that are out there, but there are opportunities to repurpose some allocations of power, whether they were for aluminum smelters in the past or lumber mills or other large industrial properties. There's still a lot of pockets of that scattered throughout the US. And we'd expect to see some more of those converted to data center operations going forward. I can think of a few examples in the Southeast, a few in Ohio, a few out in kind of the mountain states as well. So there are pockets of power available. In terms of grid capacity, I do think we're seeing some improvement in the timeline for certain projects to come online, or just some progress towards those projects coming online. Northern Virginia is one example that comes to mind, where there have been some challenges bringing on power over the past couple of years, but my sense is that good progress is being made and there'll be more power available over the next couple of years.
So it does sound like data center REITs are taking some innovative steps in order to tap into power.
That's right. We see kind of a variety of solutions that are in the market, and companies are becoming more creative in how to source additional power, whether that's on grid or retrofitting older sites that have power available, or sourcing behind the meter solutions. These are all options, and it seems like all options are being considered at present.
Right. And alongside all the upside excitement surrounding data centers, there's a steady flow of local pushback and regulation. How would you say the industry is navigating that tension right now?
It's a difficult setup for some of the operators. I think what distinguishes some of the better companies out there is that they have the ability to navigate some of these challenges. A lot of it has to do with just communication on the ground and letting the local community know how data center construction is going to affect their community in both the short and the long term. A lot of the things that are the cause of NIMBYism, I think, are misunderstandings about how data centers can fit into a given environment. So just one example of that, data centers can make a lot of noise, and that is a concern for populations that are living in the close proximity. But a lot of that can be engineered away as well. So some of the considerations that are leading to backlash at present can just be addressed simply by engineering or investing a greater dollar amount into the capacity to make it more acceptable to the community. There are certainly other situations where there's just such a kind of a fever pitch of backlash that it will be challenging to bring incremental capacity online. There's no doubt that there's a lot of pushback, and that could delay some of the data center build out that has been discussed over the past several years. But most of these companies have just time in the market to understand how to navigate that as effectively as possible.
And Brendan, when you look out over, say, the next 3 to 5 years, given all those different factors that are at play right now, what do you think is really going to separate the data center leaders from the rest of the field?
What separates the best data centers is the ones that have an ecosystem of clients which attracts additional clients. So the more that you can cultivate the type of tenant that is going to want to be in a facility because of the other tenants that are there, the more pricing power you're going to have. And I suppose the opposite of this would be more commoditized facilities that are more fungible. The tenants aren't there because of any particular reason other than power is available. Those are more fungible and ultimately are going to compete on price. It's a commodity service, and that service is in very strong demand right now. So that's an attractive setup for the next several years. But at some point, we will have sufficient capacity in the market. And I think it's those facilities that might lose some of the pricing power over the long term relative to the co-location facilities that are interconnection rich and have that ecosystem value.
So Brendan, for those investors who are not already active in the data center REIT space, is now a good time to enter the market?
When we look at the AI trajectory and the CapEx that is anticipated from the largest hyperscalers in the market now, there does seem to be a very long runway of additional spending and investment in data center demand. So I do think over the long term, these are still relatively attractive investment opportunities. And the constraint on supply is only contributing to pricing power going forward. Clearly, there's very strong demand. We have to be cautious that at some point there could be a reduction in demand due to a number of potential risks. But given how supply constrained the market is at present, we do anticipate that the data center operators will have a continuing strong opportunity over the next couple of years.
Brendan, we've covered lots of ground, but any other topics we haven't touched on?
Sure. I think one element that's getting a lot of attention recently is data centers in space. My view is that data centers in space are an additional option for workloads. And each workload needs to be placed where it optimizes for cost and performance, whether that's in the cloud, in an enterprise facility, in a low latency co-location facility, or in space. There's a time and a place for each workload, and data centers in space just add an additional option. I don't think data centers in space are going to be a material risk to terrestrial data centers on any time frame that investors would be looking at present. I think that to the extent that does materialize as a risk, it's 10 plus years in the future.
Excellent. Brendan, thanks so much for sharing your time today.
Great. Thank you, Sarah. Thank you for having me on.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.